Today we're going to be talking about pension sector reforms. According to current statistics, only about 11% of the organized sector is covered by any formal pension scheme. The majority of the organized sector and almost all of the unorganized sector is not covered. Another factor to bear in mind when we consider today's pension position is the change in the demographics. India's elderly are growing at a rate of about 3.8% as opposed to 1.8% growth in the annual population. In effect, what that means is the elderly are growing at twice the rate of the current population growth rate. Therefore, the elderly are set to becoming a large portion of the total population in the long run. There is a need for pension reform, certainly, and that is clear from the fact that there is inadequate coverage in the workplace. The unrecognized sector is not covered, I mentioned, and where there is coverage, the return available on the funds which are being invested is low, and that is because of the very strict rules as to where the money, the pension fund may be invested and how they may be invested. In recent years, the cost of providing for the central government employees has been increasing. Now, this is another reason for having reforms. In other words, the cost is becoming very burdensome on the public purse. Just to give you some figures, the pension liability as a percentage of GDP was 0.6% of the GDP in 93-94. It grew to 1.66% of the GDP in 2002-2003, and it is accelerating. What this implies is that in the changes that have to be considered for the future, there must be a fresh thinking of how to make the current pension schemes sustainable, so that, in other words, reconsider the funding. The government, of course, has a big role to play in any pension reforms going forward. And the first of those, in fact, the basic of those, is that some form of education, some form of a program to educate the general public regarding the need for making pension provision, advanced pension provision, must be made. They must take part, or they must set up programs to provide this awareness in the general public. Another way which where the government plays a role is offering tax incentives to the public, so that they will save more towards their pension. Now, there are arguments that this probably is not the best route for India anyway, mainly because of the huge number of people who are in the lower income brackets. So this may not be a particularly huge incentive for them. The government have, however, taken the initiative of setting up the Pensions Fund Regulatory and Development Authority. In this context, the authority has been tasked with managing the government pension schemes better, finding ways of improving the return currently available, and also offering such schemes to the unrecognized, or extending such schemes to the unrecognized sector. Apart from the government, the insurance companies have a role to play as well in this region of improvement to the pensions facilities and so on. Insurance companies have seen a huge jump in their portfolio of pension business. They have seen that up to 22% of the new business has been written as pensions business, and this pensions business sector is increasing. Therefore, they have a responsibility to expand their portfolio of pension products, improving pension products in terms of both the expenses and the range available. Of course, they're not just not restricted to individuals. They offer group products as well, and in that respect, they cover a huge number of individuals through the same contract. Insurance companies, another way they can take advantage of the current position is that they have a huge existing distribution system, a network of national as well as local. If you think of LIC, they have had this network for a long time, and they can make use of this network to pass through or to introduce pension awareness, make available pension schemes at a lower level, at a village level. In this area, some work has been done on behalf of the Ministry of Social Justice and Empowerment. Back in '99, they asked for a project on this area. In this area, a project called OASIS was set up to deal with old age and social security. And this particular project came to certain useful conclusions, valuable conclusions. One of the conclusions was that one of the recommendations was that there should be a system of individual retirement accounts. So every individual would have one of these accounts. Doesn't matter which employer they work with, this account will move with them from employer to employer throughout their lifetime, and the pension accumulated will build up under this account. When they hit their retirement age, then the fund which have been allocated to them under this account can be used to produce the income, the pension in other words. The project also recommended the use of multiple professional fund managers, different fund managers in other words, so as to who would have different strategies and therefore different ways of improving the return available. One interesting thing is that this particular project came up with a recommendation that the withdrawal facilities available under the existing provident funds should be withdrawn, should be removed. The reason is not that unclear. When one sets up a pension scheme, when one starts accumulating pension under a particular fund, the purpose of it is that it will produce some pension benefits at the retirement age. If there is a withdrawal facility, then it is reducing the fund available at the appropriate time. So more or less it's defeating the objective, the original objective. Instead of withdrawal facility, the project recommended the use of loans. So loans could be taken against fund which has been built up and then replaced before retirement. In this context, the World Bank's excellent work should also be mentioned. They have done a lot of research. They have played an important role in reforms in various parts of the world. They have studied the different reforms available, the different pension systems available in different parts of the world, and tried to learn from that and pass on that information, pass on that experience to the countries who are developing their systems. The important recommendation or important lesson they're trying to pass on is that there should be a three-pillared approach, or three-level approach to accumulating a pension or pension provisions. The first pillar or the first level they have suggested is one which is publicly managed and tax financed. In other words, a level where the pension benefits are universal, they're available to every citizen at the appropriate age. It is financed through the tax system, and by its nature, it will produce a minimum benefit. It's a minimum cover available. The next level or the next pillar they have recommended is a mandatory privately funded scheme. Obviously, it would be funded by the employer, but it would be mandatory for him to contribute to that scheme. The third level, the third pillar, is they're suggesting is a voluntary funded scheme where the employee would contribute to top up his other benefits. Obviously, where the person is not employed, a self-employed person in other words, will not have the benefit of the second level. They would actually have to go via this particular route. The Chilean model should be mentioned in this context because the government of India, in particular the finance ministry, studied the Chilean model to see what benefits, what lessons could be learned from that. The Chilean system rejects the system of accumulating funds through the government route, through the government managed provident funds. What they recommended, what the model is at present, is that the fund is managed by small or smaller fund managers, which are run privately but strictly under rules and regulations set by the government. So instead of one authority managing the funds, you have several different authorities managing the fund, if you like, which are kept under watch by the government bodies. On retirement, the Chilean system allows not only income but also a fund which can be taken at various intervals. In other words, it provides a method of a partial vesting. So one could take a part of the fund at 60, then another part at 62, and so on, depending on one's requirements. The system provides for benefits, comprehensive benefits, and including income for widows and orphans, and death benefit and permanent disability. Looking at the UK, there have been recent moves for reforms in the pension sector, particularly in the state pension sector. And the reason, or the driving force behind it, is that the government has found that the UK government has found that the state schemes are becoming very expensive. The funding is becoming having to be raised every year. So the reforms which are being they actually asked a particular committee, the Pension Commission, in fact, to do some research and come up with a report, which they did in 2005. And the main proposals were that because of the expenses, obviously because of the rising costs, the retirement age should be raised. Currently it's 65, and there is talk of raising it to 70, as high as 70. So the benefits will not start for someone until they reach the 70th birthday. The proposal is that the employers will have to contribute compulsorily to this scheme, but there is a provision for sharing the cost with the employees and the government. Self-employed individuals will be able to join the scheme on a voluntary basis. Another aspect of the proposal is that the running cost should be kept to a minimum. A figure of 0.3% has been mentioned per annum. And the underlying route to this scheme would be that underlying benefit to the scheme would be that it would provide cover for everyone, every member of the public from a particular age. But if any individual wants to opt out of the scheme, they will be able to do so. So coming back to India, the Pension Fund Regulatory and Development Authority was set up under a government initiative back in 2003 to promote old age income security by developing and regulating pension funds. That was their brief. And they have already started by overseeing the new pension scheme, which is now effective for the government sector, for the central government employees. And the main driving force behind this was, of course, cost again, because the defined benefit scheme which existed up to that time was becoming too expensive. The new scheme, which is compulsory or mandatory for anyone joining from 2004, anyone joining the central government employment force from 2004 is compulsory, as I said, and the government will contribute 10% of basic salary plus DF towards this scheme, and the employee is required to contribute a further 10%, and that is supposed to fund the benefits under the scheme. I will stop there for the time being and throw open the discussion under this heading. Thank you.